What if I told you that $100,000 sitting in your account right now could pay you $700 every single month, not in 30 years? Starting next month. While most people let their money rot in savings accounts earning 0.5%, there's a completely different game being played by those who understand dividend investing. And the numbers are about to shock you. See, Harry thought dividends were for boring retirees getting their 2% yields, until he discovered that some ETFs are paying 8.41% annually. That's not a typo. But here's what really changed everything. These aren't risky penny stocks or complicated option strategies. These are ETFs holding America's biggest companies, paying you monthly or quarterly like clockwork. The average American has $65,100 saved for retirement. That's not even close to enough. But what if that money was working differently? Quick disclaimer. This is educational content about investment strategies, not personalized financial advice. All investing involves risk. Today, you're discovering 3 game-changing revelations about financial planning. First, why certain dividend ETFs are paying 2 to 3 times more than traditional funds. Second, the specific funds that smart money is quietly accumulating. And third, the compound effect that could turn your $100,000 into a retirement savings machine. Let me show you exactly what Harry discovered. Most people think dividend investing means accepting tiny yields for safety. They picture boring utility stocks paying 2 to 3% if you're lucky. But the dividend landscape has completely transformed. Harry's wake-up call came when he realized his $100,000 in savings was earning $500 per year. Meanwhile, certain dividend ETFs were paying $8,400 annually on the same amount. The traditional investment portfolio model says, buy growth stocks and wait. But what if you could get paid while you wait? There are now ETFs engineered specifically to maximize income while managing risk. These aren't your grandfather's dividend stocks. These are sophisticated wealth-building machines. And the first one Harry found changed his entire perspective. CDL, the Victory Shares US Large Cap. High Dividend Volatility Weighted ETF. This isn't your typical dividend fund. It pays you monthly. Not quarterly, like most funds. Monthly. Your salary comes monthly. Your bills come monthly. Why shouldn't your passive income streams? With a 3.25% yield, you're looking at $270 every single month from a $100,000 investment. But here's what makes it fascinating. The holdings breakdown. 25.16% in utilities for stability. 20.76% in consumer defensive for consistency. 19.65% in financials for dividend reliability. Only 3.69% in volatile tech stocks. The top holdings tell the story. Evergy Inc. at 1.78%. Johnson & Johnson at 1.50%. Coca-Cola at 1.40%. These are profit machines that have paid dividends for decades. The expense ratio? Just 0.35%. That's $350 per year on $100,000. But here's what Harry noticed. The 10-year dividend growth rate, 34.49% annually. That's not the yield. That's the growth rate of the dividend itself. Your income doesn't just sit there, it explodes over time. CDL has paid dividends for 9 consecutive years. Through COVID, through market crashes, through everything. But Harry kept digging, because while $270 monthly sounds good, he wondered what else was out there. Most dividend investors eventually discover SCHD, the Schwab US Dividend Equity ETF. And there's a reason it has 127,500 followers tracking every move. This fund has increased its dividend for 13 consecutive years. Not just paid it, increased it. Think about what happened in those 13 years. The 2020 pandemic. The 2022 bear market. Through it all, SCHD kept raising dividends. The yield sits at 3.80%, higher than CDL. But here's the kicker. The expense ratio is just 0.06%. 6 basis points. That's $60 per year on $100,000. On $100,000, You're collecting $3,800 in dividends while paying just $60 in fees. The top holdings read like a dividend growth hall of fame. AbbVie at 4.13%, ConocoPhillips at 4.10%, Chevron at 4.07%, Cisco Systems at 4.02%. These are companies with fortress balance sheets, companies that generate billions in free cash flow. The 5-year dividend growth rate? 10.38% annually. Your income literally grows faster than inflation. If you invested $100,000 in SCHD 5 years ago, your annual dividend would have grown from roughly $2,500 to $3,800 today. That's a 52% increase in income without adding a single dollar. The fund holds 103 companies, giving you instant diversification. 20% energy exposure for commodity strength. 18.5% consumer defensive for recession resistance. Harry was impressed. This was financial independence in a single fund. But then he discovered something that made SCHD look conservative. JEPI, the JP Morgan Equity Premium Income ETF. This is where things get controversial. An 8.41% yield. Harry did the math 3 times. That's $700 per month from $100,000. $8,400 annually from a single ETF. Most people see that number and think scam. But JEPI has $41.28 billion in assets under management. So how is this possible? JEPI uses a covered call investment strategy on the S&P 500. They buy quality stocks, then sell options against them for extra income. Here's the simplified version. They buy Microsoft stock. They sell someone the right to buy it at a higher price. They collect a premium. They pay you that premium as dividends. The holdings are blue chip beautiful. Alphabet at 1.79%. Meta Platforms at 1.66%. Microsoft at 1.62%. Nvidia at 1.60%. These are the most valuable companies on Earth. The monthly dividend averages $0.37 per share. That's predictable cash flow every 30 days. But here's the trade-off. In strong bull markets, you might underperform pure growth because those covered calls cap your upside. The 5-year dividend growth rate is 31.03% annually. But that's misleading. The yield fluctuates based on option premiums. Smart investors don't put everything here. They use JEPI as an income engine within a broader portfolio. Which brings us to the sleeper fund most people miss. FDVV, the Fidelity High Dividend ETF. This fund does something unusual. It captures dividend growth and technology exposure. With 26.07% in technology stocks, it's positioned for the AI revolution while still paying dividends. Tech companies traditionally don't pay dividends. But FDVV found the exceptions. The yield is 3.10%, but look at the performance. 5-year total return, 137.71%. That crushes the 63.46% median for all ETFs. You're getting growth stock returns with dividend income. That's the holy grail of wealth building. The dividend growth tells the real story. Last year's growth, 22.04%. 5-year average growth, 10.42%. The expense ratio, just 0.16%. The top holdings: Nvidia at 6.36%, Microsoft at 5.56%, Apple at 5.19%. You're getting the Magnificent 7 with dividends. FDVV manages $7.02 billion in assets. It's paid dividends for 8 consecutive years. 19.68% in financials for interest rate benefits. 11.25% in real estate for inflation protection. The fund holds 120 companies. More diversification than SCHD's 103. Harry started doing the math on combining these funds. Now here's where Harry got strategic. He built a dividend machine. Here's the exact asset allocation. 30% in SCHD for rock-solid reliability, $30,000. 30% in JEPI for maximum current income, $30,000. 25% in FDVV for growth potential, $25,000. 15% in CDL for monthly payments, $15,000. Each fund serves a purpose. SCHD is your foundation. JEPI is your income engine. FDVV is your growth kicker. CDL is your monthly smoother. The exact math. SCHD, $30,000 x 3.80% is equal to $1,140 annually. JEPI, $30,000 x 8.41% is equal to $2,523 annually. FDVV, $25,000 x 3.10% is equal to $775 annually. CDL, $15,000 x 3.25% is equal to $488 annually. Total annual income, $4,926. Monthly income, $410.50. But that's just year one. Here's what Harry discovered about reinvesting dividends. Take that $4,926 annual income. Reinvest it at an average 5% yield. Add 7% annual dividend growth. Year 1, $4,926 in dividends. Year 2, $5,270 in dividends. Year 3, $5,639 in dividends. Year 4, $6,034 in dividends. Year 5, $6,456 in dividends. By year 5, you've collected $28,325 in total dividends. Year 10, $9,503 in annual dividends. Year 15, $13,987 in annual dividends. Year 20, $20,581 in annual dividends. By year 20, your monthly income hits $1,715 from your original $100,000 without adding another penny. Harry reinvested everything for the first 5 years. His dividend income doubled. His principal grew to $127,000. The compound interest effect is mathematical reality. Each dividend payment buys more shares. More shares generate more dividends. More dividends buy more shares. After 10 years of reinvestment, Harry's portfolio hit $163,000. His annual dividend income reached $9,500. That's $792 per month in completely passive income. But here's what separates winners from wishful thinkers. They start before they feel ready. They reinvest when others spend. They focus on yield and growth. Most people wait for the perfect time to invest. Meanwhile, dividend investors get paid to wait. Harry learned 3 critical rules. First, time in the market beats timing the market. Every month you delay is a dividend payment missed. Second, dividend cuts are rare in quality ETFs. These funds hold dozens or hundreds of companies. Third, inflation makes waiting expensive, but dividends often grow faster than inflation. The 4 ETFs we covered aren't recommendations. They're examples of what's possible with money management. SCHD for stability and growth, JEPI for immediate high income, FDVV for tech exposure with dividends, CDL for monthly payments. Each serves a purpose in your financial goals. Your $100,000 doesn't have to sit in savings earning nothing. It could be generating $400+ monthly within 30 days. Think about what $400 monthly means. It's a car payment. It's groceries for a family. It's a step toward financial independence. With reinvestment and dividend growth, that $400 becomes $800, then $1,200, then $1,600. Eventually, your dividends cover your expenses. That's when work becomes optional. The only question is whether you'll still be reading about dividends a year from now or collecting them. Harry made his choice. His dividends now cover his car payment, insurance, and groceries. In 5 years, they'll cover his mortgage. In 10 years, they'll replace his salary. Financial freedom isn't about getting rich overnight. It's about building passive income streams that grow while you sleep. And with dividend ETFs yielding up to 8.41%, that freedom might be closer than you think. The path is clear. The math is proven. The only variable is whether you'll take the first step.